All right, now let's go ahead and get into Microsoft's earnings. Okay, Microsoft, hear me out. This stock's been on a freaking tear, and I don't think you can deny it. Year to date, let's just take a peek. Because you want to know. Only up 31% year to date, but if we look a year out, at 50%. And again, there's a lot of stocks that have really gone up a lot more, but really since pandemic shutdown and everything, the stock's up another 50%. It's beautiful. Can't say the stock is up quite as fairly as I think it might be, and it's down after hours, actually. It's down. So let's take a look at these earnings and see if that warranted the stock going down. So Microsoft EPS, oh my gosh, beats by 9 cents on EPS, $1.46, and revenue up 12.8% year over year, beats by $1.48 billion. Son of a gun. I told you to expect beats on both top and bottom lines here, but that is an incredible revenue beat. Incredible. $1.48 billion. To see a growth of 13% on this company is incredible. I expected 10% growth, right? I expected big growth. But that even is incredible. Quarter two Intelligent Cloud revenue of $13.4 billion, up 17% year over year, versus the consensus of 13.1. Gotta love that. And the company's guidance of 12.9 to 13.1 definitely beat that. So let's look at some of the finer details here. Stock's down after a beat. Productivity in business processes was 11.75 versus a consensus of 11.9, so a miss on that. Intelligent Cloud, obviously, as we mentioned, a beat. More personal computing, 12.91 versus 11.47 consensus. So that's where you see the biggest beat at, is more personal computing. And again, that's going to include everything like, well, you think about Microsoft Xboxes, you think about, obviously, just Surface tablets, you think about just anything Microsoft concerned, Windows, everything that could be. That is more personal computing. Pretty nice to see a big beat on that aspect. Work and learn from home trends helped the productivity in businesses and intelligent cloud segment, though traditional license slowed, and LinkedIn was up 11% year over year in constant currency. Was negatively impacted. So LinkedIn took a hit. Not a shocker, because LinkedIn's focused on getting people jobs, right? And a lot of these small businesses weren't looking for jobs, right? They couldn't even stay in business. They were forced to close down. So nice to see it. More personal computing. You see Windows operating system up 7%. Surface tablets up 30%. Xbox up 68%. And I entirely anticipated that. Gaming trends are massive. Benefited from remote trends, while search was down 17%, was hit by ad spend cuts. Again, lower revenue or lower ad spending obviously hits these tech companies as far as their search engines are concerned, because not many people are buying the ads, and they're buying them for cheaper. Azure's revenue was up 50% in the quarter, decelerating from the 61% last quarter. Not awful, but I mean, you say 50% is just a lovely growth. Lovely, I must say. Operating expenses were up 13% year over year, including a $450 million charge for closing the physical stores. So that's why you see that. Microsoft returned $8.9 billion to shareholders this quarter, which was up year over year, 16%. And then we also have that's right, the earnings slides, baby. You already know I love to see earnings slides, especially when there's lots of charts and lots of data. Oh, I love data. We talked about growth year over year in terms of these categories. Definitely nice to see that. Gross margin up 10%. Operating income up 8%. You like to see that. You definitely like to see operating income rise. But you know what? That net income was down 15% year over year. And I don't think that's that bad. Net income decline of 15% is really not that bad when you talk about a vast majority of companies are seeing 50% declines in terms of EPS. So I honestly respect it. It's pretty good. Earnings per share to be only down 15%. It's definitely a win for this company. I mean, what more do you want me to say? It's a win. So for commercial highlights, you see commercial bookings growth. Overall, we saw a 12% growth here. Not quite comparable. Really, you can't really see the difference here compared to quarter four of last year, where they say 22 to 25. So definitely some slowdown there. But it's all, again, this is commercial, so we're talking about bookings with companies that might not be doing business at the current time. So commercial bookings grew 12%. Commercial remaining performance obligations of $107 billion was up 23% year over year. So they have more obligations that they need to perform than before. So therefore, more of that money will be locked in the future. And again, it's hard just to do. You can't just do consistently 30% growth all the time. It's really impossible to. As far as commercial cloud's concerned, was up 30% year over year. Good to see that. Really good to see that. Other financial highlights, obviously cash return to shareholders. $5.1 billion in repurchases and $3.9 billion in dividends. Operating expenses, obviously because of stores closing, not unexpected at all. Really nothing crazy to see on that aspect or really anything else there. Cash flow is up, though. I do like to see that. From productivity and business processes, Office commercial product and cloud services were up 5%. Office 365 commercial revenue growth was up 19%, though. Very nice to see that. All Office commercial products and cloud services was up 6%. Was continued in Office 365 consumer subscribers to 42.7 million. So continuous growth there. LinkedIn revenue increased 10% in a quarter which it really shouldn't have. It shouldn't have grown. LinkedIn revenue should not have grown this quarter. But it shows you the growing base that company's bringing in, or really that application, that website. It's good to see. Dynamics products up 13% and Dynamics 365 revenue growth of 38%. For Intelligent Cloud, you see server products and cloud services revenue increased 19%, driven by Azure revenue growth of 47%. Woohoo! You gotta love to see that. It's just consistent. And again, I think investors are maybe selling because of this Azure revenue, and they might be smoking something. So they put in some work. I like it, but I mean, 50%. That's not good enough for investors nowadays. I don't know. You can't consistently grow 60%. As far as more personal computing, you see Windows operating went up 7%, as we saw. We see Windows commercial products and cloud services revenue increased 9%. Xbox content and services revenue increased 35%. Woohoo! What can I say? Xbox, we knew was going to be. Gaming's been massive. Surface revenue increased 28%, and search advertising, we saw a decline. So, as we talked about previously, as far as productivity in business, we saw really the fine details there. Nothing super exciting with these, because we look at the overall, and you see on the bottom here this chart as far as Azure revenue growth is concerned. But again, it's so hard to see. You can't be growing 60% consistently year over year, and at some point you have to slow down, because by the law of large numbers, you're increasing probably the same in terms of revenue dollars, but the percentage goes down, right? That's just kind of how it goes. I'm hoping that they give me the balance sheet with this company as well, because I love to look at the balance sheet. Oh, they didn't. So, you know what we have to do then? You'd never seen typing like that. I'd mistyped. Okay. I was typing like the freaking Flash there. You kidding me? Yes, mister. Let me click on this. Would you like some Rogaine, please? Sorry, that was offensive. I shouldn't say that. Oh, we're getting there. We're getting there, baby. Woo, there it is. We're going to zoom in for you, because obviously you need to be able to see this, okay? Okay. So you look here. We get an actual year-over-year comparison. That's why I love you, Microsoft. Year-over-year comparison. Cash equivalents of $13.5 million versus $11.3 of a year ago. Baby. Total current assets of $181 billion. That is freaking incredible. Over $175 a year ago. Gosh, that's incredible. Look at that money. Total assets in general of $301 billion versus $286 of a year ago. Good improvement there. Then we go straight to the total liabilities, and this is where you see how fantastic this company is. $183 billion versus $184 of last year. So not only did they increase their total assets overall by $15 billion nearly, they also decreased their liabilities by $1 billion. Are you kidding me? That means stockholder equity has increased even further. $118 billion in stockholder equity. Let me just get that one out. $118 billion that they have. Oh my gosh, that's just extra. That's incredible. So we talk about buying this stock, and I think even at these valuations of $200, I think this stock's still a buy. And some of you may say that's incredible, but valuation-wise, it's only in the 30s in terms of PE ratio. It's only in the 30s. And people may say, well, 30s, that's pretty high. This is a company that warrants it. Growing over 10% revenue consistently, well, but the company is so focused on the future, and every part of the business is focused on the future. This is a very well-run company, and I think it's just well poised for the future. And even at $200, it's a fair buy. I don't think it's the most fantastic buy, but I think it is a very good buy for a consistent long-term holding. It is a very good long-term holding, no doubt. I mean, I got in at $80, and I wish I had bought so much more. I wish I bought so much more when I did, but that's okay. I love this company.